Thank you, everyone, for joining us for this investor update on the Biotech Growth Trust. Let me first begin with a brief introduction to the trust for those of you who are less familiar with the fund. The Biotech Growth Trust is a closed-end investment trust designed to generate capital appreciation through investing in the global biotechnology industry. The biotech universe can really be categorized into two major groups of companies. The first are what we call major biotech or big biotech. These are the largest largest companies in the sector. They're profitable, they have earnings, and they can be valued on traditional metrics like PE and earnings growth. And then the second category of company are what we call emerging biotech. These are companies that are still in development stage, not yet sustainably profitable, may not have any revenues, and require regular financing to fund their clinical trials. So this particular trust does invest in companies across all stages of development with an emphasis on emerging biotech. We make investments across geographies, therapeutic areas, across a variety of drug development technologies, and those investments are made based upon our scientific appraisal of drugs in development, as well as financial analysis of the future revenue and earnings potential of these companies. The closed-end fund structure does allow us as the manager to make investments in private companies, as well as use gearing to enhance returns, all with oversight from a board of directors. And OrbiMed is a healthcare specialist that has managed the trust since May of 2005. Here's a slide just showing the biographies of the portfolio managers of the Biotech Growth Trust. I'm a general partner at OrbiMed. I've been with the firm for over 20 years, and I've been a portfolio manager of the Biotech Growth Trust since May of 2005. My colleague, Josh Golomb, is a partner on the public equity team at OrbiMed, and he was recently appointed earlier this year as a portfolio manager of the Biotech Growth Trust. He brings with him nearly 20 years of experience investing in biotech at a number of healthcare investment firms. So collectively, both of us together have over 40 years of experience investing in biotech. So here's just a snapshot of OrbiMed, the firm. We are a global healthcare dedicated investment firm with over 25 years of experience investing solely in the healthcare sector. Current assets under management stand at $17 billion, and that is distributed across multiple business lines, which are shown in the pie graph on the left. You can see that we have a private equity business, we have a royalty and structured debt business, and of course, we have a public equity business, of which the Biotech Growth Trust and the Worldwide Healthcare Trust represent a majority of the assets of that business. So those two funds are a core focus of our organization. Globally, we have 139 employees. We have been gradually expanding over time. We made over 25 new hires in 2022 and 2023. Collectively, our investment professionals have over 300 years of experience investing in the healthcare sector, and over 35 of my colleagues have either an MD or PhD degree, so we have quite a bit of technical expertise in-house. So OrbiMed has extensive resources to invest in biotech. We believe we truly have a differentiated platform that is capable of delivering strong returns in this sector. We do have a true global footprint, so 12 locations worldwide, including offices in New York, San Francisco, Hong Kong, Shanghai, and London. We can basically invest anywhere in the world, whether it's the United States, Europe, or Asia, and that does provide some geographic diversification for our portfolio. We have a large research team, so 7 analysts dedicated to the biotech sector, including Josh and myself. Collectively, that core team has over 60 years of collective investment experience, and that is supplemented by additional expertise from 12 other public equity analysts covering other healthcare sectors like large pharma and life science tools and diagnostics. Our platform does give us preferential access to deal flow. So the firm does get wall crossed on 3 to 4 deals per week. What that means is that an investment bank will contact us to inform us that a biotechnology company is contemplating a financing. We get that information confidentially, have some advance notice to due diligence on that particular deal to determine whether or not we want to participate. Not all investment firms out there get wall crossed, and so given our stature in the industry, we're one of the handful of firms that regularly gets wall crossed on these deals. And lately, as part of that wall cross restriction, we actually do get some access to confidential information about the issuer. So in some cases, we'll actually get clinical trial data that has not yet been released to the public, and we can make our investment decision based upon that data. So a true informational advantage here in some of these deals, and we are very selective in the deals that we participate in. So we've been wall-crossed probably close to 200 deals so far year to date, and we've participated in less than 5% of those deals. So in some cases, of course, warrants and other deal sweeteners are also available that can be present to enhance returns. We also have a leading private equity business that has a dedicated team of 51 investment professionals, and they provide preferential access to crossover opportunities and IPOs in OrbiMed companies. It's important to note that the Biotech Growth Trust has the option, but not the obligation, to participate in those deals. So Josh and I can make an independent decision as to whether or not we want to participate in those financings. The private equity team also aids in diligence for both IPOs and other publicly traded names, and they have regular interactions with the business development teams of all of the large pharmaceutical companies. And that's because large pharma is interested in learning about OrbiMed's private portfolio and looking for assets to perhaps in-license or even companies to acquire. And as a part of those discussions, we do get some insight into which areas are of particular M&A interest for large pharma, and that can help guide our public equity investing. Lastly, as I mentioned, the firm does have extensive experience investing in healthcare and biotech specifically. We've been doing this for over 25 years. So we do employ a disciplined investment process in constructing the portfolio. Here is a schematic showing elements of that process. On the left-hand side, under primary idea generation, the ideas basically are generated from our team of dedicated biotech analysts. Each of them is assigned a specific universe of stocks to cover, and they are responsible for determining which of those stocks would make the best candidates for the portfolio. We tend to focus on stocks that have some sort of value-creating catalyst over the next 12 to 18 months. And those ideas are typically discussed at a dedicated weekly biotech meeting. At that meeting, we also go through the portfolio over each name line by line to make sure the thesis on that particular stock is intact, and we will make appropriate adjustments and trading decisions depending upon the state of that thesis. That is supplemented by daily meetings of the whole public equity team that occurs pre-market, where we discuss pre-market news and again make appropriate adjustments based upon the impact of that news on our portfolio. And for instances in which there is a significant binary catalyst for one of our core positions, whether it's an FDA approval decision or a phase 3 clinical trial result, we will convene a special deep dive review meeting of those catalysts to attempt to come to a decision about whether or not that catalyst is likely to succeed or fail. And our private equity colleagues frequently join in those discussions as well. So throughout the investment process, we are cognizant of risk management. It is true that at the individual stock level, biotech can be quite volatile. We do diversify across multiple parameters in the portfolio. So we are diversified by size and stage of company. We are diversified by geography. So we have positions in the US, Europe, and China. We are also diversified by therapeutic area and across drug development technologies. We adhere to prudent position sizing. So the sizing of our positions does depend on conviction level in the idea, liquidity of the stock, and risk reward of the idea. We aim not to lose more than 100 basis points of performance on any single catalyst. And so the typical position sizes range from 5 to 10% of NAV for large cap biotech and 1 to 3% of NAV for emerging biotech. Those position sizes are actively managed to navigate the catalyst paths of emerging biotech stocks. So the turnover of the fund is actually relatively high, about 90%, in some cases above 100%. And that is because the fund does regularly trade around its position. So we are trimming when the valuation gets too high, we are adding when the valuation gets low, and we're always looking dynamically to ensure that the position sizes appropriately reflect the risk reward of the investment, especially in advance of binary events. Now, the volatility of biotech does increase markedly as one descends in market cap. The table at the bottom shows the average annual volatility of stock constituents of the NASDAQ Biotech Index by market cap band. And you can see that small cap biotech has a 1 standard deviation expected move per year of plus or minus 84%. So quite a bit of volatility, especially at the smaller end of the biotech universe. And so our fund's emphasis on emerging biotech, especially with an emphasis on ones with stock-moving catalysts in the near future, means turnover will likely remain high for the fund to manage risk appropriately. So now let me turn to fund performance. Here's a slide just showing the performance of the Biotech Growth Trust since our inception as managers in May of 2005. You can see that up to the beginning of 2021, we had accumulated quite a bit of excess performance versus the NASDAQ Biotech Index, our benchmark index shown here in gray. But unfortunately, in 2021, we saw a massive, unprecedented drawdown in the biotech sector, especially in the small and mid-cap end of the universe. And we have yet to recover, unfortunately, from that performance drawdown. Of course, this is very disappointing to us, very frustrating to us. We are working hard to restore performance of the fund from current levels. And I think there are many reasons to be optimistic that the valuation contraction we've seen does present a compelling opportunity to get into the sector. So one of the principal drivers of that drawdown that we saw in 2021 was a divergence in performance between large cap biotech and small and mid cap biotech. And this graph shows exactly what happened there. In the lower left-hand corner of the slide, you can see a table where we have looked at the Biotech Growth Trust portfolio as of March 31st, 2021, and split the constituents of that portfolio into three market cap categories: large cap companies above $10 billion in market cap, mid cap companies between $2 and $10 billion in market cap, and small cap companies less than $2 billion in market cap. And we've juxtaposed that market cap distribution with our benchmark index, the NASDAQ Biotech Index. And you can see that at that time, March 31st, 2021, we were basically extremely underweight large cap biotech versus the index and extremely overweight small cap biotech versus the index. Now, unfortunately, as you can see from the lines on this graph, what we saw subsequent to March 31st, 2021 was a significant underperformance of small and mid cap biotech versus large cap biotech. So small cap biotech in particular has underperformed by about 35 percentage points since March 31st, 2021. And obviously, given the way that we structure the portfolio versus the NASDAQ Biotech Index being underweight large caps and overweight small caps, this was a significant headwind to relative performance versus that index. Now, where does the portfolio stand today? In the upper right-hand corner, you see another table showing the market cap breakdown as of the end of October. And you can see that we are still underweight large caps and overweight small caps. And that is because we do firmly believe that small caps are overdue for a recovery in performance. We do think they will revert in performance and catch up with their large cap peers. So I will note that the divergence in performance by market cap was not anything that was particular to biotech. This is a phenomenon that we actually saw across the broader markets. And so here's a graph plotting the Russell 1000, which is a large cap index since March 31st, 2021, versus the Russell 2000, which is a small and mid cap index. And you can see that, again, you see a notable underperformance of the Russell 2000 compared to the Russell 1000 of about 28 percentage points. So again, nothing necessarily specific to biotech, but certainly I would say among unprofitable tech companies, those small cap names in particular did suffer the most in this drawdown. So we do believe that the current valuation in biotech does present a compelling investment opportunity for the sector. And let me now review those points. So this graph shows the XBI's relative performance versus the S&P 500. So the XBI is an ETF that tracks an equal weighted biotech index, the S&P Biotech Select Industry Index. This is a proxy that many people use to track small and mid-cap biotech performance. And we've plotted the relative performance of this index versus the S&P 500 since the index's formation in 2006. And you can see that over time, for most of this time period, the XBI has outperformed the S&P 500. So biotech has been a good sector to invest in, but there have been some transient periods where the XBI has underperformed the S&P 500, and that is shown by the red circles on this graph. After each of those periods of underperformance, historically speaking, we have seen a period of outperformance of the XBI versus the S&P 500. That is shown by the green arrows on this graph. And so on the very right-hand side, you can see how unusual this latest drawdown has been. It has really been unusual in terms of its severity. It's the longest drawdown we've seen of the XBI versus the S&P 500. It is the largest absolute drawdown we've ever seen of the XBI, and is the largest relative drawdown of the XBI versus the S&P 500. So since the latest peak, the XBI is down more than 70% versus the S&P 500. We do believe that the historical pattern is going to persist here, and that we will see a period of outperformance of the XBI versus the S&P 500 over the coming months. And the reason we believe that is if we look at the absolute valuations of biotech right now, we are really now sitting at unprecedented record lows. So here's a graph showing the median ratio of market cap to net cash on the balance sheet for the biotech sector since 2001. And you can see that the current drawdown has really driven valuations to the lowest we've ever seen. So we're now trading at valuations that are below the dot-com bust, below the great financial crisis, below Hillary's drug pricing tweet during her election campaign, below the US-China trade war tension and the advent of COVID-19. We've never seen valuations this low before in the sector. Another way to look at that is if you look at the graph on the left, if you plot the percent of biotech companies trading below the net cash on the balance sheet, 25% of the industry is now trading at market caps below the net cash on the balance sheet. And you can see in historical context how unusual that valuation is. And that translates on the right to over 100 companies that are now trading at negative enterprise values. This is something we have never seen before. Now, one of the principal drivers of the drawdown that we saw in 2021 is the fact that we have seen a rapid rise in interest rates over the past few years. So if you look at this graph, with the drawdown in 2021, we see that that did coincide with a rapid rise in the 10-year interest rate that's shown in the dotted blue line here. And but I would note in the broader historical context, if you look at previous periods, here's a period, for example, between 2016 and 2019, where the 10-year interest rates were rising, and yet biotech also showed strong performance. So we do think the biotech sector can perform even in rising rate environments. And encouragingly, if you look at the rightmost portion of this slide, you can see that from early 2022 to today, the 10-year rate has gone from about 2% to 5%. And yet over this period of time, whether you're looking at the XBI in purple or the NASDAQ Biotech Index in gray, or our fund in dark blue, it seems like things have stabilized a bit, meaning that it seems that the biotech sector is less sensitive to this most recent rise in rates. And that is suggestive to us that we have hit a valuation floor for the sector. So if there is still incremental interest rate pressure in terms of rising interest rates, we think it will actually have minimal negative impact on the sector from current levels. The Fed obviously has telegraphed most recently that they're taking a pause on raising interest rates in the short term. They're going to continue to monitor, obviously, the inflation statistics coming out of the economy. There are many market prognosticators who do believe actually that rate cuts are going to happen in 2024. Of course, if that happens, that would be a tremendous tailwind for the sector. But we believe that even if interest rates remain steady, biotech can recover from the current oversold condition. So here is a snapshot of the performance of the Biotech Growth Trust for the current fiscal year since March 31st, 2023. The NAV is shown here in black, the price here is shown in blue, and the NASDAQ Biotech Index here is shown in gray. The vertical dotted line on this graph designates September 30th, 2023. We have just issued our semi-annual report for the trust that covers the first 6 months of the fiscal year. So I would invite all of you to take a look at that report if you're interested in more details about the first 6 months of performance of this fiscal year. But you can see that overall, so far, fiscal year to date, we are outperforming the NASDAQ Biotech Index by over 5 percentage points. Clearly, we have quite a lot of work to do to get back to our previous highs. But again, we are working hard to restore that outperformance. So the major key takeaway that I really want to communicate in this presentation is the fact that the share price declines we've seen in biotech over the past 2 to 3 years is really disconnected from the fundamentals that we're seeing in the industry, which remain very, very strong. And I'm now going to turn it over to my colleague, Josh Golomb, to discuss some of those investment themes and why we're still very, very bullish about the prospects for the sector. Josh?
Thanks, Jeff, and thanks everyone on the line for tuning in. I wanted to share why I'm excited about the opportunities that exist in the biotech sector. So if you go to the next slide, this one depicts the number of drugs that were in active human testing each year. As you can see, there really was a dramatic increase over the last few years. Drugs are being tested in greater numbers across a large array of therapeutic areas. Part of the reason for this increase is the number of drugs tested are utilizing novel technologies. While the human genome was sequenced back in 2001, many of the targets discovered were not druggable through traditional means. The advent of these novel technologies has made it possible and spurred breakthrough innovation. As you can see on this slide, a steady rate of increase in drugs in development have been fueled by these technologies, all of which you are exposed to as an investor in the trust. Now this slide, the next slide, depicts recent FDA approvals that have come out of biotech companies. You can note that included on this slide are consensus sell-side peak sales projections for the products. Vyvgart, which is in the upper right-hand corner of the slide, was approved and launched in 2022 for myasthenia gravis. This year, 2023, marks the first full year the drug will be on the market, and argenx, the sponsor, is on track to sell well over $1 billion of Vyvgart this year, achieving blockbuster status. All the drugs listed here have peak opportunities to achieve blockbuster status, and like Vyvgart, many have already done so. Now, all these drugs were developed inside biotech companies. Under some of the drugs, you'll notice that 2 companies are listed. The reason for this is simply that the biotech company innovated and developed the drug, but was later acquired or partnered for marketing purposes with pharmaceutical company. So we listed both of them just so you can see them here. So 2 slides ago, if you go to the next slide, we showed that innovative technologies were used to fuel acceleration in drug development. Here's a list of these technologies in the bubbles, and you can see the percent of NAV that each of these technologies are reflected in the fund as of the end of October. Now, some of the companies work on more than one of these technologies, so the numbers don't add up to 100%. The bottom bubbles list some of the trust's holdings, again, as of October 30th, that are utilizing these technologies. And this is just an illustrative way of where you get exposure in the trust to these novel technologies. So on the next slide, you can see that we've had an increase in not only an increase in drug testing, like I talked about before, but an increase in new approvals by the FDA as well. So these drugs are making it through trials and have for the last few years resulted in roughly 50 new molecular entity approvals a year. 2022 was an exception simply because late-stage drug testing was slowed down during the COVID pandemic in 2020 and 2021, but we're back on track in 2023 for 50+ approvals. Now, on the next slide, I wanted to share some of the significant FDA approvals that occurred in 2023 that came out of biotech companies. So this list is just some of the drugs, again, that came out. But one thing that I wanted to note in the highlights column is the word first bolded in front of all of them. And one of our investment tenets in the trust is we look for drugs that are first to market or best in class and address an unmet medical need. This summer, so second from the bottom, I'm going to use an example. This summer, BioMarin's Roctavian became the first gene therapy approved to treat hemophilia A. Hemophilia is a bleeding disorder where people's livers don't produce enough clotting factor. Factor replacement is the traditional therapy that's been used for decades, but requires administration via IV, intravenous infusion, 3 to 4 times a week. Now, Roctavian is a single, so one-time IV infusion of gene therapy that delivers the gene to the liver to produce the clotting factor naturally. Well, it's unknown how long the therapy will last. The vast majority of patients derive benefit and did not need to take any supplemental factor for 3 years after they were administered the gene therapy. That's as long as the study data we have. We'll get updates. So while this is not a cure, this creates a drug holiday for patients so that they don't have to take the factor therapy 3 to 4 times a week and could really feel normal. On the next slide, I'll show you some recent technology breakthroughs that have come out of biotech companies. One I'd also like to highlight is second from the bottom, which is a development for acromegaly by Crinetics Pharmaceuticals. Acromegaly is an endocrine disorder caused by a benign tumor in the pituitary gland at the base of the brain. While the tumor is surgically removed, surgeons usually don't get all of it out. The condition with the tumor causes growth hormone to be overproduced in adults. Since in adulthood you're done growing, it doesn't result in height increase, but rather it's diagnosed with an increased hand size and increased feet. If left untreated, this disease also can lead to downstream cardiac and metabolic issues. Now, the current treatment is a monthly shot administered by your doctor. So you have to go to the doctor once a month and get a painful injection. While the medicine is effective, it does tend to wear off in the last week of the month, causing people to have symptoms and feel generally bad. And they also get headaches as well as are fatigued. Crinetics developed a once-a-day pill to replace the shot and was able to show that it was effective in 83% of the patients treated. What's nice about the pill is because you get to take it every day, you don't have the wear-off effect of the last week of the month. Additionally, it's much more convenient to take a pill at home every day in the morning than have to go to the doctor once a month to get the shot. So one of the tailwinds that we see in the biotech sector on the next slide is the patent cliff that large pharmaceutical companies are experiencing. They have a particular need to replace revenues at the end of the decade, as you can see from the chart on the left. Nearly $250 billion of patent expiries exist. We've listed some of the mega blockbuster drugs here, just so you can see the companies that sell them on the slide as well, the year they lose exclusivity, and the sales that are at risk based on the 2022 reported sales. Pharma's not waiting until the last minute, and M&A activity has really picked up over the last year and a half. Jeff has shown you the historical low valuations in the sector. We think to a certain extent, Pharma agrees based on the significant premiums that they've paid to acquire biotech targets, as you can see listed on these slides. The rows that are shaded green on the slide are targets that the trust owned at the time of the announcement of the deal. We believe that M&A trends will continue into 2024 and should hopefully provide a tailwind for the sector. And with that, I'll hand it back to Jeff. Jeff, you're on mute.
So just to summarize, what is our 2024 strategy and outlook? Well, the strategy is to continue to emphasize emerging biotech over large cap biotech because we continue to believe that emerging biotech is going to recover from the unprecedented lows that we see valuation-wise, and we want to fully capture that sector rebound. We will continue to capitalize on compelling investment opportunities in companies that need to finance at low share prices. The gearing level of the trust will generally stay between 5 and 10%. And again, we're really seeing record low valuations in the emerging biotech sector that suggest significant upside from current levels. The performance drawdown we've seen in small and mid-cap biotech versus the S&P 500 has been the longest and most severe we have ever seen. The percent of biotech companies with market caps below the net cash on their balance sheets are well above historical norms. Valuation levels are really lower than the great financial crisis and the bursting of the dot-com bubble. And we do think actually that interest rate headwinds are abating. For those of you who are fearful of a recession in the United States, I would also point out that biotech has historically outperformed the S&P 500 in a recessionary environment. Again, the main point I'd really like to communicate here is the fact that the valuation contraction we have seen over the past couple of years is disconnected from the fundamental innovation in the sector, which remains robust. M&A activity, as Josh just mentioned, is expected to accelerate given the lower valuations of biotech targets and the urgent need for new products by big pharma as they face loss of exclusivity on a lot of their blockbuster products. So in conclusion, OrbiMed believes that this is an excellent time to invest in biotech innovation at unprecedented low valuations. So with that, thank you very much for your time, and Josh and I are happy to answer any questions you may have.
Thank you very much. Just to reiterate, please, could you submit any questions via the Q&A button at the bottom of your screen? We've got a number of questions ready. First one, how does the emerging biotech exposure in the trust today compare versus history? Has it reduced due to these price falls? And do you have strong conviction still that you'll start to add?
So we did undertake a strategy shift in 2019 to emphasize more of the emerging biotech companies in the portfolio. And one principal reason for that is, if I could just turn to the appendix here, if you look at the overall industry drug pipeline, the graph on the left shows the share of the industry R&D pipeline by company type. And the light blue shaded portion of that graph shows the contribution of emerging biotech. And basically, over the past several years, emerging biotech has accounted for more and more of the proportion of drugs in development. So in 2021, they were responsible for nearly 2/3 of the drug industry's R&D pipeline. And so the thinking was, it makes sense to us to match the portfolio exposure in the Biotech Growth Trust to where the innovation is actually taking place. If most of the innovation is taking place in emerging biotech, that is where most of our exposure should lie in the trust. So prior to 2019, I would say we had much more big biotech exposure. Post 2019, we have emphasized more of the emerging biotech end of the universe, and that will remain the case for the foreseeable future.
Brilliant, thank you. With the emerging small cap biotech sector being so undervalued, why have we not seen more M&A activity? Can you explain why this is not currently occurring and what possible catalysts might change either valuations or the M&A activity itself?
So here's a graph showing the M&A activity in 2023. I guess we would argue that M&A is occurring right now. M&A is a two-way street, meaning that you have to have a willing buyer and you also have to have a willing seller. And I think some of the perhaps lack of M&A that's occurred is not because there aren't willing buyers, but because there are some CEOs of some of these emerging biotech companies that are just not willing to sell at these depressed valuations. They may have a price target in their head based upon how the stock was trading back in 2020, and it will take some time to get them to shift their mindset in certain cases. Now, given the financing environment in biotech, where we have very low share prices across the board among emerging biotech, the alternative to selling to a large pharma company is, of course, raising money at these very, very low valuations. And of course, if one does so, it is extremely dilutive to share price. And we believe that that recognition is going to lead more and more management teams of these younger emerging biotech companies to basically say, you know what, I don't want to finance at this low price. It is actually better for shareholders if I do sell to a larger player. So we do think as the LOE, loss of exclusivity of many of the big pharma blockbuster drugs approaches, they will be even more desperate to acquire some of these biotech companies. And if the current financing environment persists for younger biotech, there will be more willing sellers as well.
Thank you. There's talk of AI in every walk of life. In terms of biotech innovation, how do you see the speed and quality of innovation change with the application of AI into the process? And how is BIOG or OrbiMed set up to address this change?
So artificial intelligence is being used broadly among companies in the biotech industry for their drug development efforts. There are a few companies that have a specific focus on AI. Thus far, we haven't found them to be trading at compelling valuations. But I would say that AI is a trend that we are going to continue to see across the whole sector. So basically, I would say every single company by now has some sort of internal AI effort underway. And hopefully that will lead to more drug candidates and drugs that are more likely to succeed in the clinic.
And what's your opinion of the impact obesity drugs will have on the sector in terms of derivative application?
So certainly the obesity theme has been a major driver of big pharma performance, Lilly and Novo Nordisk in particular. Of course, this is a biotech fund. We don't invest in large pharma, but we do have a couple of positions in the portfolio that are levered to the obesity space. We recently made an investment in a company called Scholar Rock that is developing an anti-myostatin antibody that will help patients who are on a GLP-1 agonist retain their muscle mass. So right now, if you're on a Novo's drug or Lilly's drug, yes, you lose a lot of weight, but that includes muscle mass. You also lose muscle mass. Wouldn't it be great if one could develop a companion drug to be used in conjunction with those GLP-1 agonists that will allow you to lose just the fat and retain your lean muscle mass? And so we have an investment there. We also have an investment in China in a company called Innovent that has one of the leading GLP-1 GPCR agonist agents for obesity. It's shown nearly best-in-class efficacy so far in obesity, so we have some exposure there. So we will selectively choose within the biotech universe companies that we think have attractive prospects in the obesity space, and we'll continue to do that.
OrbiMed have been developing their China presence and also in emerging markets. Has your opinion on China changed at all over the last few years? And are you seeing opportunities there and perhaps in other emerging markets and where you work?
Sure. So I think one of the differentiating aspects of our platform is that we actually have offices in Shanghai and Hong Kong. I have 3 analysts based in Hong Kong and 1 based in Shanghai, and they are looking at Chinese biotech opportunities. And if I could just once again turn to the appendix. Essentially in 2021, we were hit by 2 macro trends, unfortunately. One was, of course, the rising interest rates in the United States, but in China, we also had, unfortunately, a negative macro picture where there were COVID lockdowns for quite a period of time, and then post the COVID lockdowns, everyone was expecting an economic recovery, and unfortunately, that recovery has been much slower than anticipated. And so, fundamentally speaking, government commitment to developing a biotech industry in China has not changed one bit. So I think the fundamentals of innovation in China remain present. And the cardinal rule of investing in China is to always invest in alignment with what the Chinese central government wants to happen. So if they want to be the leader in electric vehicles, sure enough, today they are the leader in electric vehicles. So that government commitment has continued unabated. We are seeing a rise in innovation in China. China actually now represents 15% of the total worldwide drug development pipeline. Over the past 5 years, the number of drugs in development in China has tripled. So the fundamentals of the industry remain intact. We are seeing some interesting opportunities there. The macro picture, though, has been difficult. And Just as in the United States, we're seeing the XBI trading at all-time lows. Here is a graph showing the Hong Kong Healthcare Index, and it too is also trading at all-time lows for completely different reasons. In the United States, we have the Fed raising interest rates because the economy is too hot. They're trying to slow down the economy. In China, we have the exact opposite scenario. We have an economy that is too cool, and the Chinese government is trying to stimulate the economy. But regardless, just as we've said that the performance of the biotech stocks in the United States are disconnected from the fundamentals of those companies, in China, the same thing is true. We think that these stocks have been beaten down due to macro trends that is disconnected from the innovation that's actually taking place there. And we still have many big pharma companies really eagerly trying to in-license innovative assets out of China. Some of you may have read that AstraZeneca just in-licensed an oral obesity compound from a Chinese company. So we will be selective in investing in China. We do think the macro backdrop will improve in China eventually, and we're just going to, basically be investing based upon fundamentals of these companies.
Thank you. Going back to the approval pipeline, what is the share price impact with some of these biotech approvals in terms of being a de-risking event, new investors coming in, re-rating the stock? I mean, what is the kind of actually tangible effect it has on some of these share prices?
Josh, do you want to take that for a moment?
And I think that it varies. It certainly, as the questioner stated, de-risks the company and de-risks the ability to have future revenues. So it opens the opportunity for new investors to come in. It depends on where the stock price is trading at the time, obviously, and depends on the opportunity that exists. And we actively manage ahead of these events based on the share price to take that into consideration. So I will acknowledge I didn't answer that question directly because frankly, it is situation specific.
No, thank you, Josh. Just a question, is royalty financing something that you would consider having exposure to in the Biotech Growth Trust?
So we're really going to primarily focus on equity investments in this particular trust. We, of course, have a dedicated royalty effort and a separate fund where we would allocate those royalty opportunities.
Thank you. Given the cheap valuations, to what level would you potentially increase exposure to emerging or small cap biotech within the trust?
Sure. So if you go back to the slide of how we are positioned, here's how we were positioned. This is a market cap breakdown, so it's not exactly a one-to-one match versus emerging biotech and large cap biotech, but you can see here that we have a fairly significant weighting in small and mid cap biotech. I think we're comfortable with that positioning right now, and it's really going to be dependent upon bottoms up which companies we find attractive right now to invest in. And so a lot of it's going to be bottoms up driven. If you see a lot of compelling opportunities in emerging biotech, that will gradually increase as a share of the portfolio. But given what happened back in March 31st, 2021, where we really pretty aggressively positioned in terms of being overweight small cap, we want to be careful as well in how we position this portfolio going forward to make sure that we manage risk appropriately.
Just a question on newly acquired positions and which ones you've been increasing. Could you give a look at how many new ideas have come in and which ones you've added given the conviction?
So unfortunately, our compliance department doesn't allow me to talk about sort of what we're doing from a trading perspective in the portfolio right now, and we're not able to talk about individual stocks. There are stocks, obviously, that we're actively adding to right now. But again, I would just say that our process is really a bottoms-up driven process. So we're looking at individual companies and whether we think they have strong prospects.
There have been developments, obviously, in Alzheimer's, which is a theme that you've been speaking of for a number of years now. But which particular areas of the sector are you most excited about given some of the developments that have come about since you started to have exposure to them?
Yeah, so Alzheimer's has really been traditionally a difficult therapeutic area to develop drugs for. We did have approval of a drug called Leqembi that's been jointly developed by Biogen and a Japanese partner called Eisai. We do own shares in Biogen right now, and that drug is in the process of launching. I think that particular area is going to take some time to develop to just get the logistics in place, but we still firmly believe it's going to be a massive market, a $10 billion plus type of market, and we are eagerly awaiting more and more Alzheimer's treatments to be introduced into the marketplace. So far, outside of the current modality of beta amyloid antibodies, some of the earlier modalities have yet to show true proof of concept. So there's a protein called tau that people are targeting and some other approaches as well. But we are constantly vigilant on making sure we keep abreast of that very interesting space, and we will seek to identify interesting molecules that are being developed for Alzheimer's as they progress through the clinic.
Now, for once, we haven't actually talked about politics, but there is a question on politics. So given the Inflation Reduction Act has been passed and we have an election coming up, what impact do you see on the portfolio going forward into next year, and how does this compare to what might have happened in the past?
So you're absolutely right. As part of the Inflation Reduction Act, there was a component of that act that did call for Medicare price negotiation. And basically, the tenets of the law basically states that a small molecule has 9 years of exclusivity before it would be eligible for Medicare price negotiation. For biologic, that was a bit longer, 13 years. Overall, we think there's very little immediate impact to the sector, though we do think, given that the exclusivity for biologics is a little bit longer before they hit Medicare price negotiation, there will gradually be a bias, if you will, towards developing biologics over small molecule drugs as a result of that. And we should see that transpire over the next few years. But there's no immediate impact in our view to the sector. And then with regards to the election, I think Republicans traditionally have been against price controls, and I still think that's going to be the case. I'm not going to be able to predict the outcome of the election, of course, for next year. But I guess I would also say that we've been talking about drug pricing in the United States for quite a long time, and drug pricing reform. Finally, it has happened. So it's my view that now that that box has been checked, we think that the Congress is going to focus on other initiatives, other policy in other areas. So we don't think there's going to be more political pressure on the sector in the near term.
Just a question on trading around binary events. Do you assess how accretive or successful you are in assessing binary outcomes on stocks? And do you feel that you've learned over the time that you've been managing the Biotech Growth Trust how to improve?
Yes, absolutely. So, these binary events are the opportunities for a lot of these stocks to generate significant value. We, of course, have to be cognizant of the risk going into those events. And as I mentioned earlier, we generally don't want to lose more than 100 basis points on any single catalyst. But we are continually trying to improve our processes, our analysis, and so forth. We have a lot of in-house statistical analysis that we do. We actually have a data analyst on staff who does a lot of that work. And we really assess each of those catalysts one by one and try to come up with the best view on whether that catalyst is going to be successful.
And going back to GLP-1 drug, what biotech segments are most impacted either positively or negatively by the rise of these?
So as I mentioned earlier, I think there are some biotech companies developing obesity drugs, and certainly ones where those obesity drugs can be paired with an existing GLP-1, I think are of high interest to us because they can basically piggyback on the large sales being booked right now by Novo Nordisk and Eli Lilly. I think some of the other derivatives of the obesity trade, which is, in the medical device sector, for instance, we've seen a little bit of pressure on those names simply because people think, people are going to get fewer cardiac procedures and so forth. We think that's a little bit exaggerated, to be honest. But I think in biotech in particular, it's just looking for other names in the obesity space. It's clearly a very large market. They are identifying new targets in obesity. And that's where I think a lot of our focus lies. What is the next new target going to be for obesity, given the size of this market?
And then just one question on the trust itself in terms of gearing and conviction in the outlook. Could you just give some detail on current gearing or expected gearing versus historical norm?
Yeah, so right now we're geared a little bit over 5%. The gearing level does tend to fluctuate between 5 and 10%, depending upon the opportunity set we see at any given time. We did de-risk a little bit in September and October when we saw interest rates continuing to rise, just to manage the risk a bit. But in no way does that reflect our lack of conviction or lack of exuberance in terms of the prospects for the sector. So you can expect the gearing range to stay between that 5 to 10% level, and as we continue to identify new opportunities, the gearing level will change appropriately.
And just one on Biotech Growth Trust position within the OrbiMed stable. How does the allocation policy work when the trust invests in a new public company versus other allocations within the group?
So the Biotech Growth Trust is the only public equity vehicle that we manage that is solely focused on biotech. So the Biotech Growth Trust gets first access or first look at any biotech opportunity that we invest in. Of course, the Worldwide Healthcare Trust also invests in biotech, and so there are shared positions between the two trusts. But I think it's safe to say that any biotech opportunity would be eligible for inclusion in the Biotech Growth Trust.
And then in terms of your access to crossover rounds, has this part of the market slowed somewhat in terms of just the appetite? And there have been some hugely successful involvement in pre-IPOs. So is this something that you expect to return?
Yeah, so I do think we have, again, differentiated capabilities in that space. Because we have a very successful private equity team, we do get access to crossover deal flow pretty much across the board. And you're absolutely right that the crossover deal flow has abated somewhat recently. And that's because the IPO window really hasn't been there recently. We've had a few IPOs, but nothing approaching the open IPO window we saw in 2020 and 2021. And so we haven't made any new crossover investments recently. We are continuing to look at them, though. And when the IPO window opens, we will be more aggressive in investing in crossovers.
Brilliant, thank you. Just looking at the questions, I think covered all the questions so far. If there are any other questions, please do add them now. If not, please email them to ir@frostro.com and we can get back to you. But I'd just like to thank Josh and Geoff very much for their time, and to everyone who's been listening into this webinar for your time as well. And there will be a recording which will be circulated afterwards. But again, Geoff and Josh, if you'd have any closing comments, I'll hand over to you. Otherwise, we will finish the webinar.
So thank you very much for joining. Again, I think this is really a special opportunity to get exposure to a very exciting area of healthcare at record low valuation. So we think the future is quite bright for the biotech sector. Thank you.
Brilliant. Thank you very much, everyone.